Chinese stocks. So because of overwhelming requests and demand, they said, Adam, can you say something about the Chinese stocks? All right, so here's the video you've been waiting for. Chinese stocks, treasure or trash. Since the beginning of the year, in fact, since last year, the selling has been relentless. The stocks are like free falling. So you've got Alibaba down 73% from its highs. You've got Yum China, which is actually an American company doing business in China, that's 46% down from its highs. You've got Tencent down 53% from its highs. You've got JD down 55% from its highs, and almost everything in China is down huge double digits. So, is this the opportunity of a lifetime? Is this real treasure that can make you extremely wealthy if you buy at these levels? Or is this trash? Is it hopeless? Is it never going to come back? And these are my thoughts in this video. So in full disclosure, as you guys know, I've mentioned this before, I own Alibaba, I own JD, I own Yum China, I own Tencent, and I own Chinese ETFs. Currently, the allocation to my portfolio is about 12%. So before the drop that started over a year ago, it was like about 18% at the time of my portfolio. But since it's been dropping, it now makes up 12% of my overall portfolio. The rest are US stocks. And individually, for example, Alibaba now only takes up about 1.8% allocation in my portfolio. So initially, when I first bought Alibaba, I bought it actually quite some time ago. I built up a position of about 3.5% of my portfolio. And then it went up initially, went up a lot to about 5.5% of my portfolio. And then it dropped, so it's now down to 1.8% of my portfolio. So Chinese stocks don't make up a huge part of my wealth, my portfolio, but 12% is not insignificant either. Now, have I been holding my stocks? Yes, I've been holding all the way, so I know how you feel, right? You feel exactly like this. And every day looking at it go down and down and down, it's like being kicked in the nuts, and you're like, yeah, I'm still there, I'm still holding, I can't take it. So the $1 million question is, as an intelligent investor, what's the right thing to do? Yeah, I mean, you bought a stock and the price has dropped so much, what should you do? Should you cut loss and get out? Or should you hold until it recovers? Or should you in fact buy more shares? So this is what I do. Now, before I share my thoughts, let me just say that this is not an advice, not a recommendation for you to buy or sell any of the mentioned securities. This is purely shared from my opinions only, right? So only buy and sell based on your research, your opinions. These are only my opinions. Now, some people have asked me, Adam, has this happened to you before? Of course, I've been in the market for 31 years. I'm not a virgin. I've been screwed a few times by stocks that dropped a lot. In fact, this is nothing, right? One of the bigger drops I had was American Express. Right? American Express dropped 85% during the financial crisis. I was holding American Express. I was holding Schlumberger, ticker symbol SLB, which is an oil and gas service provider, that dropped 85% as well. But in both those cases, guess what? I held on. In fact, I bought more when it was near the bottom, and eventually I made my money back and a lot more. So I've never ever lost money on an investment, because even those that dropped 80%, they always came back. Just gotta be patient. So is it the same case for these China companies? Now, I can't speak for all China companies. Like, I don't own NIO. I don't own some of these other Chinese companies that are losing money. I don't know about those. But I'm only mentioning the ones that I own, the ones that are profitable, the ones that are making money, like JD, Alibaba, Yum China, and Tencent. By the way, Meituan, I don't own that anymore. I've sold that before. In fact, I made 3 to 4 times my money. I got out before the crash, and I'm not buying that back because I think that their cost has increased significantly because of regulations, and their profit margins are no longer that attractive. So with that, let me share my thoughts on these China companies and the overall China market. So in this video, I'm going to answer a few questions. Question number 1, is there anything wrong with these businesses? So remember that when you buy a stock, you're buying a piece of a business. So some people are asking, have the fundamentals changed? Are these companies no longer good companies, right? So that's the first question to ask. Are the businesses still intact? Is it a good business? And is the price in the market purely irrational? So that's question number one. Question number two, what are the shares really worth? Is it really undervalued? Question number three, why is the market price so different from the actual value of the business? If the business is good, why is the price down 50, 60%? What are investors' concerns? And are the concerns legitimate? Are they rational or irrational? Are they short-term or are they permanent? So things like number one, the delisting concerns. What if they get delisted from the US markets, right? The second concern would be, people think, hey, the Chinese government is out to destroy private enterprises. They're out to destroy Jack Ma and Alibaba and all these conspiracy theories, right? Or they are there to nationalize the companies and wipe everything out. Is that really true? Let's look at that. Another thing would be the slowing overall growth in the Chinese economy. Is that something to be concerned about? And of course, the Russia-Ukraine war, could China be sanctioned like Russia and everything goes to zero? So let's run through all these points right now. So question number one, is the underlying business still intact? Is it still fundamentally a good company? Is there anything wrong with the company? Well, no. If you take a look at the financials, these are not loss-making companies. These are not companies with high debt. These are not speculative companies like Teladoc or DocuSign or Peloton, which are losing money, or the Auntie Kathy stocks. No, these are solid cash flow generating businesses, and the businesses are still growing. They're still having millions and millions of customers that are growing, right? Now, but having said that, their growth has slowed down quite a bit. So they're not growing as fast as they used to grow because of regulations, because of the slowing Chinese economy. Yes, the growth has slowed down, but they are still growing. They've got very little debt and they're generating lots of free cash flow. So if you take a look at Tencent, for example, now this is a screenshot from Guru Focus. You can see their revenue is still growing very nicely. Their net profit is growing very nicely. Their operating cash flow, their free cash flow is all still growing very, very nicely, right? And the next question, and again, look at their financial position, right? They've got in the short term more assets than liabilities, and in the long run, they've got a lot more assets than liabilities. So these companies can never go bust. You can't go bust if you have got more assets than liabilities. It's impossible, right? Now, then of course, the next question would be, okay, so it's still a good business, right? Growing slow, but it's a good business, right? So what are the shares really worth? Now remember, a business is a money-making machine. As simple as that. The more money it makes, the more cash it generates, the more it is worth. So how do you determine the value of a business and hence its shares? The value depends on how much cash it can generate in the next 20 years or more, and you discount that future cash to present value. So I use a discounted free cash flow analysis to value these companies. Now, of course, it depends on the growth rate that you use. So I've got kind of like a base case and a pessimistic growth rate. So in the case of Tencent, for example, you can see that my intrinsic value calculation is between $800 to $837. So at a current share price of $367, that's more than 50% discount of the actual value of the business. So this is the discounted cash flow analysis for Tencent, and I'm looking at the one listed on the Hong Kong exchange, right? So this is the last 12 months of operating cash flow. This is the total debt of the company. This is the cash and short-term investments. These are the projected growth rates, number of shares outstanding, and that gives us an intrinsic value of 806 Hong Kong dollars. Now again, if you want to learn how to calculate this yourself and do your own research, this is what we teach in our value momentum investing courses, as well as our Wealth Academy investment masterclass that you can check out from piranhaprofits.com. How about Alibaba, everyone's favorite stock? Yes, the growth has slowed down significantly, and it's a combination of a couple of things, right? Again, the slowing Chinese economy, and their profits have slowed down, in fact, but that's more temporary because they've been heavily investing in new initiatives that have not yet turned profitable. But despite all these headwinds, despite all the regulations, they are still growing, right? And they're still throwing out cash flow. And they've got a lot more cash than debt, right? So take a look again, revenue is growing, profits growing, free cash flow is growing, and they have got a shitload of cash that they are basically debt-free. If they want to pay up all their debt, they're debt-free. So these companies, they can't go bust. They can't go to zero because they actually hold lots of cash, which is a lot more than, in fact, most US companies that have a lot more debt, in fact, right? So Alibaba's the intrinsic value that I calculated is between $190 to $230. So that's the range, right? The pessimistic to the kind of like the base case scenario. So I have lowered the intrinsic value. It was higher earlier, but because of the slowing growth, I've lowered it. But even with it being lowered, it's still at half price, right? Last closing price, $86. Now, doesn't mean that it can't go lower. Yeah, it can still go lower because of negative sentiment. People are freaking out. People are dumping the shares. But ultimately, it's worth, 190 to 230. So it's an easy double, right, from the current price today. How about Yum China? All right, so Yum China owns KFC, Pizza Hut, and a lot of other coffee chains in China. And again, this is a US company that has operations in China. And yes, because of the COVID zero policy, the lockdowns, sales have gone down a bit, profits gone down a bit, but it's still growing. They've been growing the number of stores. You can see revenue is growing, profits slowed down, but still growing, all right? Operating cash flow growing, free cash flow dropping temporarily, again, because of the COVID situation, but that would re-accelerate, right? But again, this company, for example, if you compare Yum China to McDonald's in the US or Starbucks or Yum Brands, this company has got almost no debt, right? Almost no long-term debt compared to McDonald's, high debt, Starbucks, high debt. So in terms of financial strength, they are really, really strong, right? So the intrinsic value of Yum China between $70 to $86. Right now is panic selling. It's dropped to $37, right? Again, it's almost half price. Same thing with JD.com. Fundamentally great business, growing, right? So that answers the first question. There's nothing wrong with these businesses. They are good businesses. Growth has slowed, but they're still growing. They're still extremely profitable. What are the shares worth? Well, the shares are worth a lot more than what the share price is selling at right now. In fact, the overall Hong Kong market, where most of them are listed, is pretty undervalued. You can see the Hang Seng price to earnings ratio over the last 30 years. The highest PE was 36 times earnings. The lowest PE was 6 times earnings. The 30-year average, 13.87 times earnings, and it is currently selling at 9.57 times earnings. So is it at the absolute bottom? Maybe not. It could still go lower. In fact, it could go lower all the way back down to 6 times where it was back in 1998. But it's nearer the bottom than it is at the top. So there's a huge upside potential and a lot less downside volatility left. So if there's nothing really wrong with these businesses, if their shares are worth a lot more, why is the share price collapsing? Why? So you got to understand that, again, in the short term, the market price doesn't always reflect the actual value of the underlying business. That's because share prices in the short term are driven by news, by emotions, by manipulation, and by forced selling. And that's why, again, you can have a company, for example, where the intrinsic value of the business, the actual money it is generating, the performance of the business, the sales, are actually going up, right? It's a growing business. This is the actual value of the business. But the share price could be going down, going opposite of what the business really worth, right? So this is when it is, we call it divergence. It's extremely undervalued. Now, eventually, it will always revert back to its intrinsic value. Now, again, does this only happen to Chinese stocks? No, it happens to stocks from all around the world. Like I mentioned, American Express, during the financial crisis, because of, again, the negative sentiment towards financials and banks, oh my God. Now, American Express was not going bankrupt. They were still okay, right? But the share price dropped 85% because of panic. Same thing with Schlumberger, which is in the oil and gas industry. The business was actually fine. There's nothing wrong with the business, right? But because at the time oil prices were collapsing, people were panic selling, and again, the share price dropped 85%. So if you know that the business is still okay, then you can ignore the current market price. don't let it influence you, right? Ignore it. You can take advantage of it by buying more, but ignore it. Don't let it freak you out and cause you to sell a good business at a ridiculous price. You're gonna have the patience to hold, and it will come back. So in the case of these China stocks, what's causing the market to freak out and throw the shares in a panic? And again, are these reasons rational or irrational? Are they short-term in nature, or are they going to permanently damage these businesses? So let's run through these concerns right now. So concern number one, the main thing that's freaking people out and causing them to panic sell and the share price dropping last week is the fact that the China stocks listed in the US are now being threatened to get delisted from the US markets. So that's the concern now. This is nothing new, right? This concern has been there for the last 2 years. So it just got brought up again. People say, oh yeah, remember, oh my God, we can sell. All right, so this article just came out. Chinese stocks plunge after the SEC stokes delisting concerns again. So basically, here's what happened, right? So 2 years ago, back in 2020, the Trump administration, they signed into law that foreign companies, they need to get their books audited by US regulators, by the PCAOB, the Public Company Accounting Oversight Board. All right, so there it goes. It says that this was signed into law in December 2020. Under the terms of this law, publicly traded companies in countries that block audit inspections by US regulators can be delisted after 3 years of non-compliance beginning in 2021. The earliest a company would be delisted would be 2024. All right, so the gist of the matter is this. These China companies are being audited, right, in China. Now, some people think, hey, but can you trust the data in China? Hey, these Chinese companies are not being audited by some shady company. They are audited by international companies. So for example, Alibaba and Tencent, they are being audited by PricewaterhouseCoopers, an international Big Four accounting firm headquartered in the UK, right? Yum China is audited by KPMG. So they are all audited by these international auditing firms, right? Which are legitimate, right? But the US is being a bitch, all right? The US is saying, no, we want our US regulators to re-audit your audit. And for many, many years, China's like, screw you, why should you look at our books? It's already being audited by these international firms. So that's the cause of the friction, right? And right now, the SEC is saying that, hey, we're going to delist you. It's about 300 Chinese stocks going to delist you if you do not comply. Now, the earliest that they will delist these companies, like whether is it Alibaba or Yum China, would be 2024. So still 2 more years, right? Now, the good news is that the Chinese regulator, they said, hey, we don't want you to delist our stocks in the US. We are going to resolve the issues with you through regulatory cooperation, right? So the CSRC, which is the Chinese SEC, and the Ministry of Finance, they've been engaged in continuous communication and dialogue with the US Public Accounting Oversight Board and achieving positive progress. Now, so is this concern something I'm at all worried about? Absolutely not. Zero. Why? Because number one, I don't think it's going to happen. They're not going to delist the Chinese companies. This is purely political negotiation, right? Now, why? Very, very simple. Because remember that the majority of people holding these China stocks listed in the US are Americans. So the people that are going to get hurt the most are the US investors. So it's going to be very politically damaging if this eventually happens. And also, if you've been reading the news, you know that a lot of the members of Congress actually hold Chinese equities. Do you think they're going to allow themselves to go through this delisting? I don't think so, right? So that's number one. And they are going to work it out eventually. Now, even if they don't work it out and the China stocks gets delisted in the US, who cares? I don't care. You know why? Because these Chinese companies, they are also listed on the Hong Kong exchange. So at the very most, if it gets delisted, your Chinese stocks listed in the US will be swapped for the Hong Kong listed stocks. So no worries there. The only thing is that you have to ensure that your broker that you're using allows you to trade Hong Kong stocks as well. And if it doesn't, then you may want to change to a broker that does. Like, if I'm not wrong, Fidelity and Interactive Brokers, they do allow you to hold Hong Kong shares. And again, it's not going to happen overnight. The earliest that it can be delisted, if it happens, is 2024. So there's 2 more years to go anyway. So to this first concern, I would say, to me, no concern whatsoever. Panic selling is irrational. Okay, so there's a lot more I need to cover. We'll do that in part 2 of this video. So remember to subscribe so you get the notification once part 2 is available. In part 2, I'll go through concern number 2, number 3, number 4, and I'll also tell you about what I'm going to do with my China stocks. Am I going to buy more? How am I going to buy more? How much more am I going to buy? And how could you possibly make some money in the short term, even if it's going down, by using options? So all that in part 2. So for now, subscribe and get ready for part 2. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.